We've got a lot to sort of unpack here. I want to start broadly with what's going on in emerging markets, because it seemed like back in May we were seeing this rebound in EM stocks, even buying in EM bonds, and that kind of fell off a cliff in July. And when you see what's happening now with the developments with the yield curve inversion and the concerns about a global recession, do you think there's any real hope, tangible hope, for a rebound in emerging markets this year?
The only hope that I can see is actually in a trade deal, if that ever happened before the end of the year. Clearly, the possibilities are dwindling as we get closer to the end, and we get closer also to when the campaign starts at the beginning of next year. But if we were to have a trade deal, that would be positive for emerging markets. The key here is that as a trade deal really increases the uncertainty of companies to invest, it's going to hit the bottom line, and emerging markets are very sensitive to that. So, and you can see it already in the earnings. 40% of the companies in emerging markets have reported, and earnings, unfortunately, are not as we would have hoped. We're starting to see some downward revisions.
Nonetheless, EMs have been underperforming U.S. markets for years now. I think the ratio of EM to the S&P peaked in like 2011 or maybe even 2010. So even prior to the trade war, there was something structural going on. Trade war aside, is there anything that changes that longer trend? Like, what happened? Why have EMs perpetually underperformed? And what would change even if they did get a U.S.-China deal?
Actually, the answer is really simple. EM will outperform developed markets when the earnings growth of emerging markets is expected to be higher than the earnings growth of developed markets. And actually, if you look at the two curves, they really go together, and they have been like really going in synchrony for many years. So if you think about it, after the crisis in 2010, because that's when emerging markets really felt the crisis,
right.
That's when net profit margins came down. Well, instead, particularly in the U.S., net profit margins kept stable. And that's when emerging markets started to underperform. You never buy emerging markets just because they're cheap. You buy them when you see this uplift in earnings growth.
If we see the Fed come out with shock and awe, and finally the dollar stays lower for a little bit longer, would that be enough to turn sentiment for the short term?
Yes, but the Fed would have to be very, very dovish. So, and the only thing that I can see happen is that they come out at Jackson Hole and they say, they give out a statement that really indicates that they want to support the economy and global markets. But still, that's not going to be enough. I mean, at some point, the chickens will come to roost, and you will see the impact of the trade war on earnings, and that will hurt particularly emerging markets. So as long as the trade conflict stays, emerging markets will most likely underperform. And I think all markets, all global markets can perform poorly, equity markets, but the U.S. within that context will probably outperform because it has always been, if you want, the more defensive market.
So one theme that we're seeing a lot of traders bring up is this idea that governments don't really have the proper sort of mechanisms to sort of address the global slowdown, whether we're talking monetary policy, fiscal policy. I want to turn to Argentina, because with the election, or the primary, I should say, that just happened, and the potential election of Fernandez, I'm wondering if the government there is going to be able to sort of, deliver, what the public wants, the populace wants, and at the same time keep the markets and the investors and keep those folks happy as well.
Yeah, and the answer is probably no. I actually disagree with those economists on one point, that some governments do have the ability to start fiscal stimulus, but they've just chosen not to do it. And you can see plenty of examples in Europe, for example.
Germany, to name.
Yes, to name one. But in Argentina, it's very different. In Argentina, the government needs to implement policies that will necessarily help hurt the population. And, that is obviously not popular when you have an election. And I think that is what we have seen during the primaries. And now really the government is, between a rock and a hard place. We've seen that they've actually issued a small stimulus package, but that's not going to be enough. I really doubt that it will kind of move the needle.
I find this comment to be really interesting about how you can't just sort of look at the cheapness of emerging markets. And as long as the trajectory of earnings is weaker than developed market earnings, they're unbuyable. Does that mean it's not worth looking at sort of specific country opportunities, or are there perhaps even in this environment, which is not great due to trade and other factors, perhaps EMs that at least look interesting or might be closing in on a bottom.
You know, you have a point. Actually, one of the biggest mistakes that investors have made over the last few years is to look at all emerging markets as a homogeneous asset class. They're not homogeneous. India, Brazil, China, you know, the risks and opportunities that each of these countries will face are very different. So we do still see opportunities in emerging markets. Clearly, Argentina right now has some issues. We would not want to be there. You're really catching a falling knife. But there are other countries that are far more interesting, and I think, you know, even the current context will do well.